Thanks, Jeff. Thanks, Tom. My name is Matthew Lemieux. I'm a senior research analyst here at Lipper. And so what we're going to be looking at is, we've seen the performance view from both the equity and fixed income side. We're going to be looking at the preliminary U.S. fund flows for the third quarter. Just as a reminder, the reason we call these preliminary is for the fact that we just haven't gotten all of our September assets in. We have the vast majority, so numbers may change a little bit over the next week as we get the rest of those in, but for the most part, we should have a good view of how the third quarter really kind of played out. So let's kind of jump right into it and kind of go to the larger groups here. So for the Q3 preliminary, what we're looking at is basically our 7 macro groups, and we want to kind of see the contrast because we've definitely seen a lot of difference in the activity when it comes to mutual funds as well as ETFs. And if you look at the headline numbers, I think it's a pretty stark comparison to what we've seen over the last couple of months, even though in a lot of cases we've seen positive flows. But mutual funds have pulled in about $102 billion for the quarter. Now, this is going to be your open-end mutual funds. We're also going to be including variable underlying funds, or those funds that are underpinning variable sub-account policies, insurance products, and then ETFs, $52.1 billion. If you compare this to Q2, last quarter we saw mutual funds in the negative, about 10.5 billion. Again, with the caveat that about 68 billion in outflows for money market funds that really dragged that group. But for ETFs, last quarter we saw only about 14.8, and it kind of goes back to, I think, a lot of the conversation we talked on the performance side on Q2, where really we were just kind of in a lull, not much performance, not really a lot of investor confidence. Again, really kind of underpinned by concerns overseas in China, Europe, as well as here in the U.S. People, I think, for a long time have been trailing and kind of under this cloud of doubt because of Europe specifically, but also because of some of the slowed growth in the emerging markets. And it seemed that Q3 really kind of opened the doors and kind of got that confidence going. So let's kind of look at it on a base-by-base basis. Once again, U.S. diversified equity, very stark difference here. This quarter we saw about $39.5 billion out of U.S. diversified equity. That compared to about 29.5 or 30 billion last quarter. So really, U.S. diversified equity, when it comes to your mutual funds, have just continued to really take it on the chin. A lot of investors moving out of that group. But on contrast, we see 21.1 billion going into ETFs. So a lot of big questions are investors really kind of just giving up on mutual funds and going into ETFs? I think that part is part of the story. I think that a lot of it, though, kind of looks through more of the story between active and passive, and I'll talk about that a little bit more as we going forward. But again, 39.5 billion out of U.S. diversified equity, and it's really somewhat surprising because over the last few quarters we've seen really pretty spectacular returns for the U.S. diversified equity group. As Tom was mentioning, I think we saw about 5.29% of positive return for that group this quarter, and 12.85% year-to-date. If you look at the year-to-date outflows for U.S. diversified equity mutual funds, it's sitting around $90 billion, or roughly 2.5% of the assets at the beginning of the year. So investors really are kind of fleeing that area. It seems that, yes, some of that interest is going into ETFs. It may just be investors going towards the passive side, wanting to buy the market. It may be people that are sitting on the sidelines going into ETFs. Also, we'll talk about a couple fund companies specifically that really have been driving some of those flows. Going to the sector equity, for mutual funds, it was relatively slow, $1.7 billion in, but we see with ETFs, we saw about $15 billion into that group, which is pretty heavy. Last quarter, we saw only about $2.9 billion going to the sector ETFs, but 15 this quarter, so a lot of investors going into that direction. And world equity, kind of a surprise to me. Last quarter, when you talked about mutual funds for world equity, we saw about $11.2 billion going in. A lot of it continuing to go into emerging market products. And really, it had nothing to do with, I think, any kind of correlation with positive returns. One thing we've been talking about on the mutual fund side and the ETF side is the emerging market exposure has continued to increase as investors really are looking to diversify their portfolios in the equity basis, trying to position themselves for the future growth some years down the road, probably with the emerging markets. But this quarter we saw $1.1 billion out. So it was somewhat interesting, especially with the good news that we saw coming out of China, as Tom had mentioned, and some of the good news out of the ECB towards the end that would have really downstream effects to the emerging markets area. But again, ETFs really did quite well, $9.2 billion this quarter. And again, in contrast, it was kind of a flip-flop this quarter. Last quarter for ETFs, we saw 5.5 out. So this quarter, mutual funds are down, ETFs are up. The next group really is going to be one that we've been focusing on for some time now, taxable fixed income, $70.8 billion for the quarter. That compares to about 45.5 for the quarter last year, so doing quite well. If you look at the 70.8, that makes up about roughly 2.8% of assets as of the beginning of the quarter. So a lot of investors really continue to jump into taxable fixed income. If you look at the year-to-date numbers, we're sitting somewhere around $215 billion total into this group, or roughly 9.2% of assets. So no matter really kind of how the market is and how investor confidence and the view on global markets is, really investors still continue to feel more comfortable as lenders as opposed to the equity side, even when taking on risk, whether it's high yield. On the ETF side, we saw about $6.3 billion, so a little slower on the ETFs. Last quarter, we saw about 16.6. So investors really kind of flocking to the taxable side. Again, there are some specific funds we'll talk about that have really done quite well this quarter. Municipal debt continued to do very well, $14.5 billion. That's on top of about 10.2 that they did last quarter. And the ETFs pretty much the same as we saw last quarter, about 500 million in. I mean, realistically, this is a very small group of products that are available, very, very small base amount of assets. One big difference this quarter was we actually did see positive inflows into money market funds, $23.9 billion. Last quarter, we saw about $68 billion out, as I had mentioned before. So there are some investors still putting some money away. Again, we've seen a lot of volatility in money markets groups. Obviously, no one's going to that group for yield. It's more of a strategic play for cash management, moving money around. So it kind of really depends on what week you look at it, depending to see how the aggregate numbers are, because it can shift pretty quickly. And then the last group is mixed asset. Tom mentioned this is a really good group to keep your eye on. $31.6 billion this quarter. You have a lot of investors that are the set it, forget it, where you have to continue thinking about defined contribution plans where they have their default investment option. A lot of money continuing to go into these groups, specifically target dates, target risk, or some of the other flexible products. Last quarter, we saw about $19.6 billion go into that group. So I kind of wanted to talk again just really quick before we go on to the next one about the diversified equity. We're seeing all of this money come out of mutual funds. Like I said before, roughly $90 billion year to date, but on top of about a 12.85% performance. Earlier this quarter I took a look. Kind of is it really just an aversion to the structure of the product, mutual funds, that everyone's kind of looking away from mutual funds and going into ETFs, or is it more just a kind of a passive versus active play, which really kind of is what I discovered. Whether you're looking at ETFs or what I did specifically, looked at mutual funds, splitting out active mutual funds versus passive mutual funds. So you got your Vanguard, your Fidelity Index products out there that really are still doing quite well when it comes to flows. In actuality, if you look at it on a simple ratio basis, from what I saw, is that basically for every $2 going out of actively managed U.S. diversified, or actually equity funds in general, there's about $1 going into the passive. So it seems that investors that are, feeling like they want to come back into the equity markets, really it seems the vote is going towards buying the market or a specific sector, but doing so in a passive way. I think some of that may be due to expense structure and saving money there, but I think investors are just not feeling as confident in the power of stock picking and the power of active management, and they would much rather buy the market, especially as they see that the market in general has done quite well over the year and the quarter. So the next group we're going to look at is ETF flow trends. I kind of like to look at this graph, basically pulling up basically 7 of good representations of the industry. If you look at it just from the high-end view, you really kind of see that the vast majority of ETFs have kind of been flat or just kind of the steady growth, and then you see SPY, which was really a big institutional tool that's been used. We saw $11.1 billion come into SPY for the quarter, but it was kind of a wild ride. Again, these are cumulative flows. As we can see, basically up until the beginning of September, the big institutional or smart money were using these products in quite a ways. They were making up and down bets as we saw kind of the market fluctuate. And then once we got to the September and we really kind of got more toward this positive investor sentiment, it's really kind of been this stagger rise going forward. So with looking at it in general, we saw SPY $11.1 billion in for the quarter. You look at the iShares MSCI EFA, really somewhat flat, not as much interest there. And emerging markets, the iShares emerging markets, 1 billion in, that's still kind of slow. So again, it kind of goes back to what we had seen, a little bit more of a slowdown towards emerging markets. It'll probably pick up now that people are kind of seeing that we'll get a little bit more stimulus out of that group and the global. Triple Q, the tech industry, so NASDAQ, power shares, pretty flat. LQD, which is the iShares iBox investment grade, about 1 billion in. And then, really the next two We're somewhat flat for the quarter, but again, kind of got a bounce toward the end of the year. HYG for the junk bond space, $2.1 billion, kind of jumping up again as the risk came on. And then also GLD, $2.3 billion in, and again that really got a boost, I think, from the announcement of QE3. A lot of investors really look at monetary policy as a driving factor for possible inflation down the road, and we saw that goes in there. I think GLD, if Tom had said, and I'd written this down correctly, up about 22% for the quarter. So a lot of investors kind of jumping in that direction, looking for some appreciation in that product. If you look at US ETFs year to date, we've seen inflows of $119.9 billion, so basically $120 billion, 11.3% of assets since the beginning of the year. So really continuing to see a large amount of assets going in there. I think as we go from quarter to quarter, we're going to see that $100 million number kind of go up. At the beginning of the year, it was right around a little north of $1 trillion. Then last quarter we were right around $1.2 trillion, and now we're at $1.3 trillion in assets for this group. So ETFs continue to draw a lot of investor attention. So let's go over to the equity side for specifics, and basically we're going to look at the gainers here. On the USDE side, once again, it was equity income funds, $3.9 billion. Investors continue to really look for yield. Last quarter we saw about $1.8 billion, and I think that, until we see possibly some downward pressure on those, Tom mentioned the tax implications that may be down the road, but at this point there really doesn't seem to be much in the way of investors going towards dividend or equity yield. The next two groups are somewhat surprising. Equity market neutral, $2.2 billion, and long short equity. Originally from the thought, it just might be that maybe some of these products are getting a little bit more acceptance into broader portfolios. But when I looked at the data, there was really a couple funds that kind of drove this. When you look at the equity market neutral, we saw the PIMCO Advantage Total Return Strategic Fund, PFATX, really brought in almost half of that at $1 billion, their institutional share. And then long short equity, we saw the Mainstay Market Field Fund I pulling in about $800 million. So some big institutional funds, again, maybe pointing to that some investors or some asset managed shops are including some of these products within their lineup or within some of their model portfolios to kind of complete the diversification of those products. Looking at the sector, we saw real estate continue to do well. Again, I think this is part of the yield play, $1.5 billion into that group. Health and biotech continued to do quite well, $773 million in there. And then natural resources, $558. I think it got a little bit of a bounce toward the end, again, because of some of the news globally on the stimulus and some of the implications of maybe some energy prices and some demand picking up again in that sector. On the world front, once again, the top two really, even though switched places, were quite the same. Global flexible funds, $5.2 billion into that for the quarter. Last quarter we saw about 4.6, so still very strong. Emerging markets, 3.3, down a little bit from last quarter. Last quarter we saw about 6 billion in there. So I think we'll continue to see this kind of ebb and flow within the positive region, and these two kind of switching back and forth. And then the last one was international multi-cap. So it seemed like if investors really wanted to get that international exposure, again, they were buying the market, $1.9 billion into that group. On the bottom end, really a lot of what we've seen before and what we've kind of talked about. If you look at the USDE, across the board, large caps really just got slaughtered this quarter. $18.3 billion out of the core section. That compares to $15.7 last quarter. Large cap growth, 6.5 out. And large cap value, about 6 billion or 5.7 billion out, which is roughly the same as we saw last quarter, about 6 billion. But again, you look at Q3 and you look at the large cap as a whole, they're roughly around 6% positive return. So it's not that they're really not giving investors some return. I think, again, it may just be some of this active play versus passive. If you look at these large cap growths in general, one of the groups we've seen out there that have somewhat struggled is American funds, their Growth Fund of America and the Growth Fund in general. If you look at those two specifically, you're looking close to $10 billion out for the quarter just for that fund. So there's a couple funds out there struggling, and that may be the case where people are pulling money from those funds going to ETFs or other products. If you look at the sector, we see global natural resources, $843 million out. So they really haven't benefited as much as we saw some of the other natural resources on the top end, the domestic side. Science and tech, about $381 million out, and global health and biotech at $260 million. So that global diversification for the health and biotech and the natural resources is really not helping them. Actually, if you look look at this sector group as a whole, these were the same three laggards that we saw when it came to flows last quarter. So really not really getting a lot of attention from investors. And then on the world side, last quarter we really saw a lot of the global diversified products on the bottom of the list. It seems this quarter it really is more international, and again maybe some of that U.S. exposure in those global products helped them out a little bit. But international multi-cap growth 2.9 billion out, international large cap growth 2.1 billion out, and global large cap core basically the same numbers we saw last quarter, 1.5 out. So over the last quarter is about 3 billion out of that group. So let's move on to the taxable fixed income. Some pretty stark numbers here. You know, again, we talked about $70.8 billion going into this group, and really a lot of that interest at the top was the intermediate investment grade debt funds. You know, these are going to be kind of your broad bond funds, your core funds, your total return funds. $18.6 billion in for this quarter, and that's compared to 1.3 last quarter. So investors really came back strong into this segment. Again, when you're talking about individual funds, you looked at the PIMCO total return. They brought in about $5.5 billion itself. If you look at the Vanguard Total Market Index, that includes their Series 2 as well, right around $6 billion. So you have $11 billion into those two products that get a lot of attention, and investors feel very comfortable with them. High yield did very well. You know, we talked about I think about 4.3% return this quarter, $11.6 billion into high yield, as the risk play and equities leaked into the bond market. Again, we'll see how this goes. I think I agree with Jeff that we might see some volatility, not only in performance in this group, but maybe flows, as we've seen kind of in the past. It's kind of up and down, oftentimes tracks the equity markets. Lipper multi-sector income continued to do well, $6.8 billion, and that's compared to about 3.8 last quarter. Some other notable ones is Jeff really talked about inflation-protected bond funds or the TIPS products. We saw about $1.3 billion going to that group, and for that group, it's pretty good and pretty strong flow. Also, we saw emerging market debt funds. They did quite well, about $4.6 billion. Again, the performance for the quarter about 6.5. So investors really feeling good about the emerging market debt, and I guess the corporate issuance is probably driving that issue. But one thing I thought was interesting, if you actually look at our new group, Lipper Emerging Market Debt Local Currency Funds, only about $1.1 billion. I mean, this group was really kind of the Cinderella story for the emerging market or the debt group in general. We've seen a lot of product creation. We saw a lot of flows in these, especially within the first two quarters. And I think a lot of that really was coming on the back of a weakening dollar, or a strengthening dollar, and then now we see kind of a weakening dollar. Maybe investors aren't looking at it quite in the same view as they thought before when it first came out. If you look in the middle, really not too much movement between Treasury and governments. That's in general. There's really not that many assets in this group. Investors really don't put themselves fully into these funds. And then at the bottom, we see Triple D, $5.2 billion out, which was somewhat of a surprise because really it was one of the top performers in, or it was the top flow getter in Q2, and it actually did quite well for performance, 3.6%. There may just be, again, some funds within that group that were dragging it down overall. But still, great quarter for taxable bond funds when it comes to flows. Next group, we're going to look at municipal bond funds. Again, this is done really quite well. Here I just kind of put in a chart from one of our weekly products to kind of show you how it's really kind of been trending within that range of about, right around 300 up to close to over $1 billion in a couple cases. If you look at it on a month-by-month basis, well, actually, overall, we say quarterly it pulled in $14.5 billion. Month-by-month basis, really July and August specifically were quite strong, and we've seen a little bit of downturn in September. Again, these are preliminary numbers. We might see a bump there, but basically 5.1 in July, 5.7 in August, and so far with the numbers that we have in 3.7 in September, so still pretty strong. If you actually look at that chart above, one thing it was interesting is if you look back kind of to the 8.15 week where we saw really it hit that peak, we saw a 4-week moving average about $800 million into this group, which is pretty strong. It's kind of dropped down a little bit more, around $500 million at this point, but that's something we've really kind of seen throughout the year. Really a 4-week moving average, somewhere around $500 million. So it still seems even though there wasn't as much interest as there was at the beginning of August, it still remains quite strong historically. If you actually look at year-to-date 2012 flows, we see $38 billion in that group. And again, looking back at all of last year, $15.3 billion in outflows. So we've well doubled that in inflows. And again, as I mentioned the last quarter as well, so far this year we've only seen 1 week of outflows, and that week was very small for outflows. The last group is money market funds. Again, this is a very volatile group. I mean, a lot of attention hasn't been paid to this group just because the yields are so low. It's really kind of just been an in and out movement for especially institutionals. But basically what we saw is a lot of money coming in July, 29 billion into that. August, a little bit less, 6.8. And of course, what we would expect in September is everyone kind of rushed back into risk, 11.9 billion in outflows. And what I kind of just did was try to give you a little bit of a different view on how this money is segmented. The top chart is basically taxable versus tax-exempt money market flows. You know, if you look at tax-exempt, for the most part, whether it's up or down, very small. And the taxable, you know, again, July was quite strong, and then September we saw it out. But the next one is institutional versus retail. You know, institutional money really dominated the inflows in July, while actual retail money was coming out. So it kind of showed an interesting contrast there. August, both institutional and retail had inflows, and then in September, you know, we've seen institutional again kind of taking that larger sum of outflows as they kind of really put the large bets on, I think specifically in the ETF space. While retailers are also retail investors are really kind of following suit, pulling money out of the money market funds and probably putting back in it to more of risk assets. So going forward, I think a lot of the same trends and concerns that Tom and Jeff mentioned would be true when it comes to flows. I'm not going to, go over it too much, but basically looking forward, I think that, you know, now, as I'd mentioned before, really the big thing with flows is really not just performance. We've seen that performance doesn't always drive flows, especially in the case of, say, U.S. diversified equity, but really it's investor confidence. And we'd had this really dark cloud over Europe, over the United States, over the emerging markets. Volatility in markets, I think, still a little bit in the back of people's minds from last year, as we saw. And I think we kind of hit this tipping point, at least it seems at this point, where with the ECB coming out, with China coming out, and with the Fed coming out, really kind of saying, okay, you know, we all are in agreements that we need to make drastic moves to keep this the growth going, or in some cases turn it around in the market. That's really resonated with investors at this point, and this going forward. I think a lot of time people were looking at the presidential election as a possibility of some maybe some volatility in investor plans, but I really don't see that coming. I think really the next big test for investors when it comes to flows and when it comes to allocating their cash is going to be this fiscal cliff that we're going to be approaching at the beginning of the year. We all know, not only from a performance basis, from a flows basis, what the debt ceiling debate last year really created for investors, which is a lot of uncertainty. Not only are they now have to worry about just the ebb and flows of economies and global markets, but also the decisions of policymakers that in some cases have consequences on the market that may not be intended. So going forward, I think at the beginning of the year, that's really what we'll see. Throughout the rest of the year, I think flows will be steady. Now that we've kind of got this announcement of action across the globe from central bankers, it'll be interesting even if we see Spain that decides to come out for a bailout and maybe their yields rise again. There probably is not going to be as much stress in the markets or in investors' minds because they know that the ECB will basically at some point step in as a backstop for that. So we'll have to see how that goes. So that's my piece. Let me kind of see if we have any questions. We've had a couple questions about the slides. As Tom mentioned, what we'll be doing is once we get to this point, we are recording the segment. We'll be placing that on Lipper Web, as well as we'll be sending out the slide deck to anyone that was registered or attended the meeting. So we'll have those out available. Other than that, I don't see any questions. We can give it just one more minute if anyone wanted to chime in.
Well, we thank you for joining us today then. We'll go ahead and call this quits. We do look forward to seeing you for our, it'll be our fourth quarter 2012 presentations, which is right now tentatively scheduled for January 8th, 2013. And again, I will have the WebEx presentation actually in PDF format out to you in the next couple hours, and we will have a replay, again, I'm thinking late Wednesday, early Thursday as well for you. So thanks again for joining us, and we look forward to seeing you next time. Thanks.